Howdy there, folks. Welcome into the Reaction channel. It's a buy one and get two free here today in this one, folks. 3 videos for me to react to. First one I want to react to is this one, okay? Bank of America CEO just went on CNBC about an hour ago or so and was speaking about the state of the consumer. Obviously, Bank of America is one of the largest banks in the world, certainly in the United States. So I want to hear what he has to say on many different fronts there. I think that's an important one. Then I want to go ahead and react to this one. Now is not the time to be throwing money at the biggest winners of the stock market this year. I want to hear why that is. Is it just because those stocks are up, so we're not going to buy those stocks? Or what does this gentleman have for insight here? And then last video I want to react to is where we should be putting money right now, and kind of hear some perspectives out there as well. So appreciate everybody joining me as always, folks. Thank you so much for being subscribed. We are now 30,000, I believe 600 plus subscribers. So new all-time high day after day. I appreciate everybody here. And as your appreciation, I put you guys as a pinned comment down there, my stock picking checklist, absolutely free to access that. You can send it over to your email. So if you want access to that, that is absolutely free. And it's 15 parts. Basically, it's a good checklist to kind of check over your stocks and kind of see, do your stocks meet these requirements or do they not meet those requirements? So, alrighty guys, appreciate you. Let's get into it.
Bank of America reporting its most profitable first half of the year, except for 2021 when there were large reserve releases, higher for longer rates, clearly a big tailwind for you and your banking peers. You have some of the lowest funding costs out there, though, and loan demand has really been steady. What's the competitive dynamic right now with regard to deposits and loans right now, and how is that impacting your pricing decisions moving forward?
Well, Leslie, first, thank you for having me, and I just want to thank, I've got 200,000 plus teammates who do a great job of customer, and that's our key competitive advantage, and they bring in loans and deposits and fees and trade well. And so if you think about what's going on now, obviously, as the rates for excess cash people don't need to run their household, became more competitive, those went in the market. And frankly, that's what some of our wealth management flows or our Merrill Edge flows are putting those deposits in the market. But the important thing is we have a huge amount, $9 trillion of deposits, and those deposits are very stable, and they represent a dominant part of the money that people move to conduct their daily lives, and therefore they're very low cost because that money is always in motion. If they're trying to get yield on money, they take it and put it in direct treasury holdings and money market funds, and we do that for them. So our competitive dynamic is different than other people's who are more CD funded and use deposits as a core funding. We have $1.8 trillion of deposits, and we have $1.04 trillion of loans, and that difference is excess, and it really represents people's money who's in motion and conducting their daily lives.
Speaking.
Yeah, so if you don't know, guys like Bank of America, JP Morgan are making out like bandits right now, okay? Making disgusting amounts of money. What's going on here? Well, obviously the Fed has done what they have done. They've moved interest rates where they've obviously moved interest rates. Well, let's call it the maybe weaker, they're seen as weaker banks out there. They have to always try to attract clients from the JP Morgans or the Bank of Americas or whoever, right? And so what they've been doing is they've been obviously moving up their savings account rates substantially. And so there's a lot of banks out there that you can get a 4% savings account right now, right? Try getting a 4% savings account at JP Morgan Chase. Try doing that at Bank of America, okay? And so those guys are sitting pretty because they're not even having to pay out these rates that these other competitors, if we want to call them that, are basically paying, okay? So, and a lot of consumers haven't really moved money off of these guys like Bank of America, JP Morgan, and others, which has been interesting. But I can tell you, the longer rates stay in an elevated place, I think the more and more people are going to look around and say, why do I have, $10,000 in this checking account over here? Or the savings account through Bank of America or JP Morgan that gets hardly any return when I can move it over to XYZ Bank and get a substantially higher return, right? And 250K, FDIC insured. So I think that's an interesting dynamic.
Money emotions, consumers clearly seem to be spending here. Growth in line with inflation for credit and debit card spending during the quarter. We did see that softer CPI print. I know inflation had been a headwind for consumer spending, in the past, but that seems to be abating a bit. Still, credit card loss rates were up about 40 basis points quarter over quarter, although still below those pre-pandemic levels. So, I'm just curious kind of how you'd characterize the health of the consumer at this point. How much do they have left in those excess savings that you were describing a bit ago?
So let's sort out two things. From a credit cost standpoint, you're seeing the activities of consumers move back to where they were But everybody talks about we're normalizing to 2019 pre-pandemic. People have to realize for our company, the 2019 charge-off rate was probably a 40 or 50-year low. Wow. And so we are at levels that are very low credit risk, very low credit costs. And we were doing $1 billion of provision a quarter back then. And, we're doing a little bit more than that now, et cetera, given a recession predicted ahead of us. So, the normalization is pretty good times in the banking system. But let's broaden back out. If you think about the U.S. consumer, what we see with the 60-plus million consumers we have is the rate of their spending, not only their debit and credit cards, which is the 3% you mentioned, but across all the ways they put money out every day, is growing at about a 5% rate through the second quarter, and frankly about the same rate for the first half of July here, which is half the rate it was growing, last quarter or end of last year over the prior quarter or year. Now, that's showing that the consumer is more in line with the low inflation, lower growth economies that were there in 16, 17, 18, 19, when the Fed raised rates and inflation was low. And so that gives me a view that inflation is getting under control. And you saw that in the spending numbers today, that you see that in some of the inflation numbers over the last few weeks. And that's good, because in the end of the day, it'd be great if we could get this inflation tamed and still have this kind of unemployment at 3.7% or whatever the unemployment rate is. That is marvelous. We'd have an unemployment-less slowdown, which would be a fantastic outcome. So the consumers are spending, they're employed, they're earning more money, and they do have a lot of money in their accounts left over. The question is, if times get tougher, will there be less employment, more unemployment? Will there be more layoffs and things like that? Right now, the activity that's taken place so far has been absorbed by the economy, and we'll have to see that happen. Remember, our team, the Candace Browning-Platt and the team lead, our research team, which is terrific, still has us having a slight recession in the early part of 24, but they have moved that out again, reduced it to 2 quarters, not 3, and lessened the depth of it to basically a soft landing, more or less 1% down in 1 quarter, 0.5% down the other quarter. So they've continued to get more, less conservative, right over the word B, on the future recession. But they still have a recession predicted.
Yeah, 2 important things I think to remember here. Okay, very important things to remember. First is, obviously, he spoke about the recession scenario. Obviously, if there's a major recession, if folks that do lose a job in a major recession, they could get in a much worse financial situation. Obviously, the economy getting slower can hurt the consumer. On the flip side, there's also a scenario in which the consumer could get in a much healthier place if real wages start to increase over this next 12 to 24 months, where you can actually see the consumer strengthening, their balance sheet strengthening, and overall, like how much money they have out there could strengthen, okay? And so it doesn't just work one way or another where the consumer is just getting worse and worse and worse. There's also a scenario in which they get better and better and better. That's something we do have to consider, especially with CPI starting to come into, obviously, 3%, likely going to be in the 2s here very shortly. And so, yeah, both sides of that, you got to think about the bad side and the good side. A lot of times people, what I find is they only think about one side, and it's like, you got to consider both, okay? All right, next video up here, this little guy is, we'll watch this one, why you shouldn't be throwing money into these stocks, and we'll see what stocks to actually be buying.
David Katz, CIO of Matrix Asset Advisors. David, it's good to see you again. Welcome.
Nice to be here.
I'm all for the rotation. It feels like a natural part of the rally broadening out. But I worry if, however many $7 trillion of market cap stalls out, what does that really mean for the whole index?
Well, basically, through May 31st, you had the Magnificent Seven doing spectacularly. The market was flat. Since that time, so since June 1st...
This guy, clear as day, a short-term trader type guy. You got that type of setup, I can tell you, you're a short-term trader guy. Do you think I got that type of setup? No, because I don't need that crap. I don't need all this stuff flashing. I need to read. I need to listen to conference calls. I need to read an annual report, okay? I don't need all this crap in front of me. Holy smokers.
The broad market has rallied and kept pace with the Magnificent Seven. And in fact, the equally weighted S&P 500 is ahead of the S&P 500 on a cap-weighted basis over the last month and a half. We think that that's going to continue. You can't have the mega cap Magnificent Seven continue to do as great as they have. Many are fully priced now, but a lot of the market right now is still attractively priced at 16 times earnings. And there are a lot of things out there that are 12 or 13 times earnings. The financials started earnings season out a little bit better than expected. You've seen a number of those stocks bounce. We think there's a lot more left over the next 6 to 12 months in that area.
So you like financials? Give us some names that are emblematic of where you think the laggards are now going to start to catch up.
Well, before he gets into the specific stocks he likes and whatnot, I think one very important thing that I have to mention here is he's kind of, talking about you don't want to be buying the stocks that have been doing well, right? I think it's a case-by-case basis. I think some of these big techs, Meta, Amazon, and a few others are going to report some pretty shocking moves up in their margins, moves up in their EPS, and potentially even some nice revenue growth on a year-over-year basis that might be a little better than what analysts are expecting. So if these companies do that, you could see kind of another, let's call it, sweet kind of move over this next 3 or 4 months.
Has been miserable this year. We think that's going to be a good place to be. So companies like Pfizer and Medtronic, we think are due for a very significant bounce. You're getting them at about 10.
Pfizer is a stock I personally own. I do like Pfizer. I don't love the stock, but I do like it. I do own it. I might buy more of it in my dividend-only account in the future.
To 14, 15 times earnings with a good yield. Morgan Stanley reported today. Bank of New York reported today. They had surprisingly good numbers and a little bit better than expected outlook. So both stocks have jumped a lot today, but they're still pretty inexpensive. And if we're right that financials catch up, they have a lot more on the upside to go.
And look at Morgan Stanley, like you said, up 6% today. BNY Mellon up 4%. You also mentioned a name like Qualcomm. There's a couple others in here. And for people who say, well, can I have it all? Why not? Would you be worried about the performance of mega cap tech?
We don't think that it's going to crap out, but we definitely don't think it's going to be a repeat. So now is not the time to be throwing money at this year's biggest winners. In terms of Qualcomm, we do think that technology is going to continue to be a good place to be. We think Qualcomm is a second derivative artificial intelligence play. We think that inventories are getting much more in check in terms of cell phones. They also
I like Qualcomm. It is a stock I personally own in the dividends only account.
Participate in automobiles and industrial, and we think you're getting it at 12 times earnings and about 2.5%, 3% yield. So this is one that you can buy. It hasn't participated in the rally. We think it's going to catch up over the next year.
All right. Well, I won't ask you for your Barbie plays. We'll save that for a later segment. David, thank you.
Yeah. So my overall sentiment to kind of finish off that video there is, I believe, yes, there's a lot more opportunities in a lot of these value stocks, these dividend stocks, and maybe some of the growth names, but that doesn't mean all growth names are bad, or some of these growth names aren't going to see very nice appreciation over the remainder of this year, because I think it's really a case-by-case basis in regards to that, okay? Alrighty, last one up here. We're putting money into the value sector. We'll hear what they have to say in regards to this one.
Earnings. Tom just told us about Bank of America. Morgan Stanley due out in just a little bit, and we are getting ready for a flood of regional results, too. Joining us right now to talk more about this is DCLA Managing Partner and Portfolio Manager Sarat Sethi, who is also a CNBC contributor. And Sarat, what do you think so far? Banks have been really strong. If you look at JP Morgan last week, what do you think of Bank of America today?
So I think you're right about JP Morgan. I think going into this earnings season, especially what happened with the regionals in the quarter, expectations are pretty low. And if you look at Bank of America, net interest income was up. Loan growth was up. Those are two things that we were all looking for, especially kind of where we are in the economy. Investment banking, I think that's going to be pretty bad for all of them. Really haven't had much capital markets activity. So looking at that for Bank of America, I think that was a positive. The stock.
In terms of that side of their business, it will start to turn in a pretty substantial way at the very end of this year and going into 2024 if the markets continue kind of this move up here. The reason a lot of companies just haven't been going public is obviously 2022 was a devastating year in the market. There was no appetite for anything going public, right? So obviously the first half of this year was just completely a dead zone. But I can tell you the longer this market stays in kind of a strengthening phase, the more likely you're going to see more and more IPOs come to the market. More and more you'll see kind of like the investment banking side of the business pick up in the back half of this year and going into early 2024. Now, if the market weakens considerably, then that business will push off. But as long as the market's in a pretty decent place, you're going to see that momentum pick up dramatically, which will help a lot of these banks' earnings on the investment banking side.
It's been a laggard compared to the rest of its competitors. It's down 11% for the year. JP Morgan's done better. And, when you look at Morgan Stanley, they're the leader in wealth management. So that's going to be interesting to see where they come across on that side and really what activity they're seeing in investment banking and capital markets as well.
I guess with Morgan Stanley, you have to look pretty closely at the markets, equities. We'll see what happens as they kind of roll into that. Do you have anything you'd be looking particularly closely?
Yeah, for them, it'd be the wealth management. 60% of their business is wealth management. Really, how did they optimize that business? We've had a good wealth management for the first 6 months. Stock market's done well. How has Morgan Stanley handled that? And I think if you look at their balance sheet, it's a very strong balance sheet compared to some of their competitors. So a different bank, but that bank has been hurt like the rest of the banks. So I think people will be trying to focus on that for different things. But Bank of America, so far came out with numbers. It'll be interesting to see what they say on the call, because it's really the future loan growth. How is that going to get affected?
I'd heard some rumblings that we could be seeing some tougher capital controls required by regulators coming as early as the 27th of July. If that's the case, would that change your opinion on any of these banks if they have to set more aside?
Not really, Becky, because if you look at kind of their multiples right now, they're trading in single digits. They've already been discounted pretty badly for these things. So unless there's something really radical, what's really going to happen is, higher reserves, and the stocks have reflected it. So really, it's going to be their operations and their ability to grow earnings. That's what we're looking at. And at a value like this, and we've talked about this for a while, the S&P trading at 17 times, the whole banking sector trading at high single digits. You really have to pick the good companies. We believe the J.P. Morgans, the Bank of America's, the Morgan Stanley's, the ones you want to own. And it'll be interesting to see what the regionals say. I think that's where you're going to get more of, hey, how much more capital are you going to need down in the future?
So, Rod, if you look...
Yeah, I think it's a very confusing time for the banks and to kind of consider banks as investments. And the reason it's so confusing right now is a lot of people are trying to figure out, are we in 2007 right now? Or are we in like 2004 right now, right? If we're in 2004, then the financials should have a very nice next 2 to 3 years, right? If we're in more of like an 07, then, it's kind of that right before time of, a lot of these banks getting hit in a massive way because of obviously a potential major recession, things like that. So I think that's the big thing that everybody's trying to figure out. And that's what makes banks a little scary. I own JP Morgan stock as the one I feel comfortable in, regardless of recession, no recession, good economy, bad economy, okay economy, those sorts of things. But I do think the banks are hard ones to consider because it's a very confusing time still in the economy, what the Fed's up to, inflation, and so I think we're getting more clear signals, but it's not like an all-clear situation yet.
Earnings overall, last quarter, there was a lot of hype around AI, a lot of excitement around it, and that's kind of what people were paying attention to in the quarterly calls. What about this time? Does that still exist, or do you really have to put up the numbers this quarter?
I think you really have to put up the numbers this quarter. AI has done great for the stock market. Multiples have expanded, especially in the tech sector. Those companies are going to have to show that their earnings are much stronger than expectations. I think given where we are in the cycle, earnings have to catch up to multiples. We've had that only the multiple expansion. So for companies that have benefited for AI, you really have to perform. But some of these other stocks, though, these sectors like financials, and even when you see healthcare coming, if they can perform, they're already cheap. And I think that's where kind of we need the market to lead outside of the AI, the big seven leaders.
Does that mean you're not a fan of any of these tech stocks right now, or at least the seven who have really had their run?
No, absolutely not. I mean, we own NVIDIA, we own, Google, but not in the size of the market. I think you have to be diversified. You have to understand what you own and take some profits and put it into sectors that haven't done well, but high quality companies. Look at the balance sheets of these companies that just like.
Yeah, and in regards to kind of bank finished thoughts here, we got obviously a yield curve that's severely inverted right now. Like a lot of people just don't want to own banks in that sort of scenario because that's once again goes back to like, are we in an 07 situation? Like, what's going to happen here? When you got the yield curve severely inverted like it is, when people look at the 2 and 10 and just a lot of people like, I'm good on the banks right now.
America or JP Morgan. So definitely own them, but just be careful in the size because the expectations are so high going forward for the next couple of quarters.
How have you shifted your allocation just in terms of what sectors you think are best? How are you versus where you'd normally be?
So we are definitely underweight. What I call the growth area. Definitely putting more money into value sector. So maybe that's healthcare, that's some financials, and really nibbling at commodities. I think given where you have the dollar globally and the need for commodities, so I think that's an area too. So areas where the market really hasn't focused, stocks haven't done much. They're either down or up very small for the year. I think having a diversified portfolio, especially now, given the growth that you've seen in some of these high stocks, that's kind of a good place to be.
We haven't talked about commodities outside of oil.
Something I will mention in regards to the value stocks and why are some of these stocks lagging? I do think there's something to consider here, and I think it's a scenario in which if there's a view of, let's say, the economy's in a weaker place, not some sort of massive recession, but just in a weaker place for the next several years. Let's say that was a view, right? Then I think a lot of these value stocks will have trouble putting up growth in that sort of environment, right? Whereas a lot of these other stocks kind of control their own destiny to quite an extent, right? And NVIDIA and Amazon, a Meta, a lot of these other companies that have been kind of high flying, they really control their own destiny, where a lot of these values are seen as, they try to eke out 1, 2, 3, 4, 5% revenue growth, and they can barely do it, even in a great economy. Like, what's going to happen if things are in a weaker state versus these other guys that, can still grow 10% revenues even in a weak economy, right? So I think that's another consideration that's out there. And I think it almost flips the script on what is safety in the stock market versus what is not safety in the stock market. Because usually safety is seen as many of the value stocks, the Coca-Colas and Pepsis and all these other different stocks, all these consumer staples. But maybe we're slowly getting into an environment where companies that control your own destiny, those are seen as more safety. So interesting times.
Quite a while. Are you looking at commodities outside of oil? And I asked, just when you saw what happened yesterday with wheat prices, based on the idea that Russia said it's no longer going to offer safe passage through the Black Sea for Ukrainian wheat, as it had done for the last year, how does that shake things up?
Yeah, I think that's a really good point. We're looking at copper companies, steel companies, aluminum companies. One of the things that we haven't really focused on in the last 5 years, even the decade, is there hasn't been a lot of investment in some of these commodity companies. So even if you get a little pricing in there, which we think you can still have, these companies trading at single digit multiples, much stronger balance sheets. So that's an area that, if you look at the market value of Apple and Microsoft, it's greater than all the energy and basic materials that are in the market. So I think there's definitely opportunity there, and investors really haven't focused on it.
Yeah, potential. I can tell you if commodities go through some sort of big bull cycle again, we're going to have another inflation problem on our hands, and that would put the Fed in a situation where they might have to raise rates more or keep them in an elevated place for a very long time, which obviously raises the significant risk to problems in the economy, right? So those are something to factor in. Appreciate everybody joining me as always. Thanks so much, folks. New all-time high subscribers. Make sure you check out pinned comment down there and get your free stock picking checklist. I put that together a few nights ago for you guys. Make sure you get access to that. Much love and have a great day.